Your bank is not the only game in town. Beneath the gleaming pillars of the financial world, a parallel universe hums away. A secret credit machine that even bankers won't brag about. So what is this underworld? It's called shadow banking. Fancy name, right? But it's not magic. It's real money. Huge piles of cash. Think of hedge funds, money market funds, private lenders, and giant investment vehicles doing everything a bank does, without the usual rules. They loan money, fuel deals, buy debt, but they aren't supervised like your local bank branch. And here's the kicker. This hidden network is massive. By late 2025, non-bank lenders held about 51% of all financial assets in the world, roughly $256 trillion, expanding at twice the pace of regular banks. Half of all assets. Think about that. This isn't some conspiracy theory. It's plain math. In plain sight, unregulated lenders have quietly gobbled up credit markets. For example, private credit funds in the US grew from barely a blip after 2008 to about $3 trillion by 2024. Globally, one analysis says private credit could soar to $5 to $6 trillion by 2035. That's debt lent outside the usual banking system by giant funds like Apollo, Blackstone, Ares, often funded by your pension, insurance pools, or wealthy investors looking for high returns. Why now? Because after the last crisis, regulators clamped down on banks. Banks had to hold more capital and raise more red flags, but businesses still need loans. Enter our shadow lenders, picking up the slack, or so it was sold. You needed a loan? A private fund could deliver it fast, for a fee, with fewer questions. The story goes, in 2008, banks got beat up, had to tighten belts. Private credit stepped in, promising a new era of finance. No red tape, faster deals. Hype said, it's innovation. Reality check. It's regulation avoidance. Pure and simple. Even Fed officials admit it. Banks tried to be safer, but all that credit just moved into the shadows. Now, facts and fallout. Remember 2025? Two shockwaves hit. Tricolor Auto Finance and First Brands Group. Obscure lenders in the US whose collapse suddenly made headlines. Why? Because big banks had lent to them off their books via all these private credit channels. JP Morgan Chase took a $170 million hit from Tricolor alone. JP's boss, Jamie Dimon, put it bluntly, when you see one cockroach, there are probably more hiding nearby. Cue alarm bells. These failures were not funded by tiny credit unions, but by the $3 trillion shadow loan market that's funding everything from car loans to condo deals. Banks suddenly felt the sting. They had essentially funded the unseen lender. The Guardian noted, the failures have led to ballooning losses at traditional banks. Flashback to 2008. Yes, you might say, but that's old news. True, the subprime crisis was history, yet shadow banking was at its core. Lehman collapsed partly because banks had shoved debt into secret, special purpose vehicles off their balance sheets. A Fed study found banks moved around $5 trillion into those shadow vehicles before 2008. Then came the run. No one trusted those shadow conduits. Credit froze. Even Nobel laureate Paul Krugman calls the run on shadow banks the core of what happened. Fast forward to the 2020s, it's deja vu all over again. Regulators around the world are worried. The Financial Stability Board, basically the banker's rulemaker, says the non-bank sector is too big to ignore. They're launching stress tests on private credit funds. The Bank of England did one. Everyone from Washington to Beijing is squinting at this shadow. In China, shadow trusts fueled the real estate boom. And when the bubble started popping, angry investors called it legalized robbery. Even the Chinese government was refusing to show investors what assets backed those loans. It's literally a state secret now. So how does it really work in simple terms? Imagine Alice runs a medium tech firm. She needs a $50 million loan fast. Banks are slow or say no. Maybe they have strict rules. Instead, Alice goes to a private credit fund. This fund raised money from big pension pools, maybe your 401k seeking higher yield. They promise Alice quick cash at high interest, no long paperwork. To Alice, it's great. To the fund, it's a gamble. They make the loan by leveraging borrowed funds, maybe lines of credit from a bank, or by issuing short-term debt themselves. Often, they'll slice the risk into fancy pieces, securitization. Now the hidden math. These shadow banks often borrow short and lend long. They might issue commercial paper or repos to fund loans, essentially juggling leverage. During good times, it works. During stress, like high interest rates, it can unravel fast. Remember AIG? They were selling credit insurance, CDS, on mortgages without holding proper reserves, all off balance sheet. When defaults spiked, AIG blew up and the Fed had to bail out $85 billion. That was official shadow banking in action. Giant risks hidden behind closed doors. Today, private credit funds often do maintenance lending. They use one firm's assets as collateral to lend to another, or they pass around collateral, rehypothecation in chains. The true exposure can end up astronomically higher than it appears. One study showed if you count all rehypothecation, America's shadow system was over $10 trillion in 2010, twice earlier estimates. That's the uncomfortable math. Each dollar in shadow banking can multiply through complex chains. Meanwhile, some think, hey, it's safe now. We fixed 2008. But pause. As one expert warns, it's not the risky stuff we know about that causes the real crisis. It's the stuff everyone thinks is safe. Ask China's middle-class investors stuck on steep losses from trust loans they thought were state-backed. Or look at regional banks with 44% of their loans in office buildings, a bubble ready to burst under high rates. The stakes keep climbing. You'd hope if shadow banks cause pain, regulators will step in. But these players dodge the usual rules. No Basel III buffers, no Fed stress tests, no FDIC safety net, by design. They exist because banks couldn't hold certain loans. So regulators are chasing shadows saying, hey, come out of the dark. But how? Look at this paradox. Banks themselves are feeding the shadows. A Boston Fed report notes banks now provide major credit lines to these private funds. In one deal, RBC and Barclays actually fronted about $1.15 billion when traditional investors balked. In other words, banks are quietly financing the same risky loans they claim they avoid. It's a loop, the regulated help fund, the unregulated. All this tech speak and big numbers might sound far from your daily life. But there's emotion here. Trust. We all trust banks. Partly because governments insure them and regulators watch them. Shadow banks? Very little oversight. If things go wrong, who's responsible? Often the losses can end up back on regular banks or even taxpayers when governments scrambled to contain contagion. Right now, inflation has cooled, but debts are still huge. Picture markets like cockroaches hiding under your stove. One scurries out, a big loan goes bad, and who knows how many others dash back unseen. That's the fear Jamie Dimon had. Ordinary people remember 2023 when Silicon Valley Bank's deposit base ran in days. That shook confidence. If a respected SVB with deposit insurance could fail, imagine a true shadow bank collapse where nobody's guaranteeing a thing. Irony check. This shadow system is invisible yet massive. It was supposed to make finance more efficient, but it actually created a second financial grid that central banks struggle to monitor. Global regulators worry about what they don't know. The White House and Fed now warn, too much risk is off the books. Even the International Monetary Fund says we face downside risks if this keeps growing unchecked. So where does it end? We've mapped out the hidden hallways of modern finance, and unsettlingly, they're not caged yet. Our economy's shadows keep growing, funding the world's deals but lurking outside the safety net. The next time you hear about a market crash or credit crunch, remember, half of that story might have been written in the dark. Fade out with thought. Can we shine a light on shadow banking before the next crisis finds us off guard?